What's up, everybody? Let's talk about what's going to happen in the marketplace. This is Sunday, July 25th. I'm in Central Standard Time here in Texas, and the market for us, the futures market, will open up in about 2 hours on a Sunday night. Yep, that's right. Future market opens up on Sunday nights. Today, I'm going to do something a little bit different. I think a lot of people out there lack experience. They lack understanding when it comes to trading. And you know what? We all lack something when it comes to trading. Nobody has all the answers. But I think a lot of people just, they really struggle with making good decisions. Things like when to get in. How do I know what my entry, when should I enter? What's the entry price? What size of the position should I take? Should I just use my whole account, all my cash, or all my leverage? How big of a position? When do I enter? When do I exit? And a lot of people struggle with those type of things, right? And their timing is off. And then they blow out their account, or they lose a bunch of money. They may not blow out their account. They may, I hope not, or they lose a bunch of money. They get frustrated. And you want to know what? Man, I've been there many times, and I bet a lot of you can attest to going through frustrating times like that. Okay? Now, unfortunately, it took me a lot of mistakes to get to the place to where I understood how to manage risk. Okay? But today we're going to talk about something that very, very few people talk about. I almost never hear anybody talk about this, especially for retail traders, which is most of us that are going to watch this video, right? Meaning we're not a large fund, right? We don't have billions of dollars at our disposal. Okay, we're not hedge funds. Okay, we're retail traders, individual accounts that a person holds. Okay, that's what most people don't have access to. What you see in front of you. Here in yellow in the upper left hand corner, you see three things: predictive analysis tools. So before I go any further, what is predictive? Obviously, to predict something means you're looking into the future and you are trying to determine what's going to happen. So that's what this video is about: predictive analysis. Most of the tools, the type of studies or charting or tools we use, almost all of them are reactive. They react to what the market has done. And very few people make use of the very few tools that are out there, which there are not a lot, about predicting what's going to happen. Because let's face it, if you could predict what was going to happen, you'd be completely retired, right? You'd have tens of millions of dollars in your account, correct? So predictive analysis isn't always right, but it doesn't mean it should be ignored. It should be part of our toolbox. So you'll see there 1, 2, and 3 predictive analysis tools in yellow in the upper left-hand corner. Number 1, forecasting. Okay, we're going to talk about forecasting. What is that? How's that done? Number 2, cycles. For those of you that know about cycle analysis, we'll talk briefly about that. I'm not going to dive too deep into it. I'm just going to talk to you about how I use it. And number 3, skew, which most people aren't even aware of what skew is. They don't even know it exists. Okay? Most people have never heard of these 3 things. Some of you may have heard of cycle or cycle analysis. Most of you have never even contemplated forecasting, and most of you never heard of skew. And only a few probably ever heard of cycle analysis, if any, watching this video. Okay? So let's talk about number 1, forecasting. What is it? Well, I just told you it's something you look into the future, try and predict what's going to happen. So let's look at the very bottom of this image you have in front of you. By the way, we're looking at the Dow Jones Industrial Average, the weekly chart. Now, why am I looking at the Dow Jones? Why am I not looking at the NASDAQ or the Russell 2000? Or for heaven's sake, you at least should be looking at the S&P 500. Not that I don't look at those. So why would I be looking at the Dow Jones? Nobody trades the Dow Jones. Wrong. We're going to get into at the end of this video, so stick around, about how I'm going to trade specifically the Dow Jones. Before we go any further, click that subscribe button. Go ahead and click that notification bell and give me a thumbs up. I really appreciate it. So the reason I picked the Dow Jones is because very few people know the Dow Jones has historical data that goes all the way back to, guess what year it goes back to? Anybody know? I'm going to help you out. At least to 1902. That's right. We got data that goes all the way back to the year 1902. Okay, that's 119 years of data. No, the S&P 500 doesn't even come close to that. Neither does anything else. The Dow Jones has been around a long, long time. That's why I look at it. Lots of useful data. Lots of historical useful data. Okay, number one, forecasting. Look at the very bottom of this image. Again, we're looking at the Dow Jones weekly chart. You'll see down there I have, if you look closely, bottom left, you'll see something called Big Daddy Forecast Forex. Okay, that's just something I named this particular forecaster. This is an algorithm, a mathematical equation that I wrote myself. I took the forecaster that exists on the TOS platform. If you don't know what the TOS platform is, that's a TD Ameritrade's desktop trading platform. You can get it downloaded for free. You can even paper trade on it. Okay, I don't paper trade on it, but you could if you wanted to. So they have a forecaster. It's a very, very good study. You should use it. Okay, but I took it and modified it and changed it and made some changes to some of the math, and I also added some other things in there, and I worked with it for quite a while, a few weeks, and came up with this, what I call the Big Daddy Forecast. This one happens to be called the Big Daddy Forecast Forex because I was temporarily using it when I was doing some foreign exchange trading. It doesn't really matter. The point is, this forecaster provides me with feedback that is extremely useful. It forecasts, or in other words, it predicts what the future is going to do. I'll repeat, it predicts. It's not reacting to the past. It may use data from the past. So in that case, it's reactive, but it predicts what's going to happen in the future. That's nice. Extremely helpful. Okay, so it's ahead of the curve, as we say. This forecaster is predictive in nature. Okay? It's ahead, meaning it's already looking to the future, and it's ahead. It's not showing a reaction. Like if you look above, look at the blue and kind of reddish looking lines right above. You got the Stochastic Momentum Index. That's another study sitting right above it. Well, that's reactive. It doesn't predict the future. But the forecaster does. If you look at the bottom, you'll see a bunch of months down there. Sorry, bumped into the microphone. You get all the way on the left, you got April, July, October, 2018, then all of 2018, 2019, 2020, and 2021. And on the far right, the very, very bottom right, you see a 22 down there. That means the year 2022. Okay? So those are the months. If you look approximately in the middle of the screen, but the very bottom, right above 2019 or the number 19, you'll see a number there. It's kind of in whitish letters, 415.296. And maybe I'll circle that. Yeah, I'll circle it. I don't have it circled now when I'm speaking, but I'm going to circle that for the video. You'll see a circle around the number 415 at the bottom. What is that number? Well, that number is a predictive scoring. Okay, I come up with a scoring system. So what's being generated right there is a predictive score. Okay? Now some huge funds, multi-billion-dollar funds who have massive staff and big employees, and they have, brainiacs, geniuses working for them who come up with predictive algorithms. And they're artificial intelligence computers. That's right, they have artificial intelligence computer software that helps them do predictive analysis, okay? Well, I don't have billions of dollars and I don't have a staff. Okay, so this is my own algorithm that comes up with and generates a predictive scoring. So that's a score. 415 is a score. And I know because I've taken the time to look at this over a period of weeks and months, probably even over a year now, I know when I see a good score. And 415, let me tell you, is a pretty doggone good score. The higher the number, the greater the probability we'll have a pullback. Okay, I repeat, the higher that scoring is, the greater the probability we'll have a pullback. Okay? So again, predictive analysis tools, number one, up there in the left-hand corner. Number one, forecasting. That's what that does. Okay, I'm using a predictive scoring to help determine whether or not we're at a top, that we're getting very topish. Okay? It's a timing thing. It's helping me to determine whether something's going to happen in the future. It may not necessarily tell me exactly when, because that requires further analysis, which is out beyond the scope of this video. Because today we're talking about predictive analysis tools. Okay? So that's something you might want to look into. Get the forecaster from TD Ameritrade. If you don't have an account there, well, go get one. I think you can sign up for free. You don't even need to make a deposit. Eventually, they're gonna make you make a deposit. But okay, I think you can do like $200. Okay, I have a friend of mine that opened up an account recently, and they put $250 in there. TD Ameritrade, no problem. Okay. Make use of the forecaster that's available to you in TD Ameritrade. Extremely powerful. You may not have my algorithm, but you at least can get started. Okay, number two, cycles. Also, if people don't understand, if you follow Steve Miller, and I'll give a little shout out to Steve Miller. I hope you're doing okay. Hope things are going good, Steve. We here in the efforts that I endeavor to do in trading and sharing my experience with other people, I like to give credit where credit's due. Steve Miller does a great job, him and his team over there at AskSlim.com. No, I don't get any kickbacks. We don't share any residual income or, any of that kind of stuff. But I'm just giving credit where credit's due. He's probably the foremost expert, particularly in the retail market, for cycle analysis. He shares it. Yeah, subscription service, whatever. I don't subscribe to him. I have in the past, and I may in the future. But I've gotten to the place to where, I don't really, okay, I don't want to put this, how do I put this? I'm not saying I don't need their service, but I don't really use their service because I've gotten to the place where, honestly, I can look at a chart and I can see the cycles just with my own eyes without even putting the cycles down. That's the place you want to get if you're going to use cycle analysis. You should be able to look at a screen and see the cycles. I can often see the cycles even before I draw them because I spent the last few years studying cycle analysis. And it's part of my toolbox. I don't rely on it exclusively, no more than I rely on number one, forecasting exclusively. Okay? So cycle analysis, let's take a look at that. What is cycle analysis? Look at the middle of the screen. You see these yellow arcs, they're like semicircles. The yellow arcs I put on the screen. Okay, remember we're looking at the Dow Jones Industrial Average weekly chart. Okay? You'll see I drew some semicircles there. So what is cycle analysis? What is the heart of it? Cycle analysis, believe it or not, and a lot of people don't understand this, is a predictive analysis tool. Yes, it predicts the future. It's also historical. Just like forecasting, you can always look back. That's fine. We have the data. We can see whether or not it was accurate. That's fine. Cycle analysis definitely shows us what's going on in the past. We can use it. But looking in the past is a dime a dozen. There are literally tens of dozens of studies that technical studies you can draw on your charts to look at the past. And I'm not saying you shouldn't. Definitely use those. But cycle analysis, real strength is it's predictive. It's predictive. And what does it predict? It predicts cycle lows. I'll repeat, cycle analysis predicts cycle lows. It doesn't predict the price of the low. It predicts the win. Okay, it predicts the win. It doesn't even predict the high, the top, or when's it going to peak. It doesn't do that either. Because in any given cycle, meaning anywhere along that, take one of these single arcs. Over here to the far right where that big red arrow is pointing down. Take that big arc. That big old arc that runs from, from 2021 out to like July or August. Okay, just to the left of where it says August 16th to 2021. That arc right there. That's one complete cycle. That is an element of time from left to right. Where the two cycles meet is predicting that it'll be a low. Today, as I do this video, it's July 19th, 2021. You'll notice down there on the right side of the screen, I have written in yellow lettering August 16th, 2021. That's the future. So predictive analysis is predicting something on August 16th, approximately, right? You with me so far? I know this video is long, but just stay with me because it's worth it. Okay, so cycle analysis predicts lows. It doesn't predict the price of the low. It doesn't predict the high before the low. It just predicts the low when, not how much. Is it useful? You doggone right it's useful. I hope you see so far, we just looked at number 1 and 2, forecasting and cycles. I hope you can see that what's going on here. I've used forecasting, my own algorithm, which is some of that is available, as I already mentioned, as a forecaster on TD Ameritrade. Okay? I'm using that in conjunction with cycle analysis and seeing if they both confirm one another. If you ever listen to some expert traders, long veteran traders, for instance, like Steve Miller and his team, what you're going to hear is confirmation. They talk about it all the time. Confirmation. Well, here it is. I'm giving it to you in plain English, as they say. I'm using forecasting, which is a predictive analysis tool, along with cycle analysis. I want to see, do they both agree with one another? Yes, they do. The forecaster is predicting something significant is going to happen. It has a high score, 415. How do I know it's high? Well, look down there at the forecaster. You see look to the far right there. You'll see a 100 and then above it a 350. If you need to pause the video to find it, find it. It's in the far right, lower right-hand corner of this screenshot. Pause the video, find the 100 and the 350 in the far lower right-hand corner. Okay, so if it's above 350, there's a reason why I put the 100 at the bottom and 350 at the top. Those are my ranges. So if it starts getting above 350, I start paying attention. If you look in the history of the forecaster along the way, you'll see some high pointy, kind of like pointy things going along above that 350 line, right? Throughout the history of it. 2018, 2019, 2020, you see those high points all along the way, right? Well, those are important points. Sometimes they don't always do something significant, and sometimes they do something very significant. Okay, so so far, predictive analysis, we've used forecasting and cycles. And they are confirming together that something most definitely the probability is high that something's going to happen approximately around the week of August 16th. It's not an exact science. I mean, you got to get to the place to where you don't get so rigid. Steve Miller talks about this. It's one of the reasons why I follow his efforts and his team's efforts. He always tells people the same thing. People get upset with him in the comment section of some of his videos. I have to chuckle a little bit because they get angry. It's not Steve's fault. Don't blame him. Take an honest look in the mirror. Reevaluate where you're at. We all have to do it. That's part of life. Suck it up. Come back. And do better next time. Remember, at the end of this video, I'm going to tell you exactly how I'm going to trade this pullback. And I'm going to trade the Dow Jones. And I'm going to talk about how I specifically do that. So stick around. Okay, number 3, the last one, skew. Most people don't even know what skew is. They never even seen skew. I got to pull it up. Give me a second to pull it up because even though it's in the front of the screen for you, I actually have to go get it. Okay, skew, there it is. The CBOE skew index, upper left-hand corner. We're looking at a weekly chart for this as well. And look at the very bottom, even though there's not a number associated with on this one, you'll notice I have the Big Daddy forecaster on there as well. I won't even get into that. That is some seriously deep stuff going on. Okay, I always put momentum there. You also see stochastic momentum index. Okay, I always use momentum. Okay, so there's the skew. I'm not going to dive too deep. The skew basically tracks the S&P 500. Okay. It is somewhat predictive in nature if you know what to look for. I'm not going to dive into the whole skew thing right now. Do your own due diligence. Study the doggone thing. Start counting things. Left to right. You're looking for patterns, guys. You want to expand your mind? You want to get good at trading? Dive into mathematics. Dive into geometry. That's right, you heard me say it. Get interested. Count the differences in cycles and in patterns. You need to be looking for that kind of stuff. Okay, I use skew and I recognize patterns. Skew is predictive if you know what to look for. Okay, you'll notice in the upper right-hand corner there of this screenshot of the skew index, you'll see a big number up there, 170.55. Okay, that may be significant. Okay, so skew is used. I'm not going to dive too deep into skew, as I already said. You need to do your homework. Yes, skew is predictive. Trust me, it's there. Find it. Okay, so up to this point, what have we seen? We have seen, let me get back to my other chart here. Oh, okay. Actually, I'm going to switch over to the Dow Jones Industrial Predictive Scoring. Okay, so now you see a spreadsheet, a screen of a spreadsheet in front of you. So what are we looking at here? You see upper left-hand corner there of the image, you got the DJI, Dow Jones Industrial. You have some dates there. Let's look at that first date. July 1st, 1929. Excuse me. July 1st, or just as monthly, just so you know, we're looking at monthly dates there. The month of July, 1929. Okay, anybody that doesn't understand the year 1929, okay, you've been asleep. You need to go back and look at your history. The Great Depression. Remember I said at the beginning of this video, the reason I look at the Dow Jones Industrial Average is because it has history that goes all the way back to 1902. And guess what I get to do? I get to apply my scoring predictive algorithm. Remember I said the Big Daddy forecast? I know it's kind of a funny name, but the Big Daddy forecast. Remember I said that I have my own algorithm? Well, guess what? Remember the score I talked about? There it is. It spit out a predictive score for me for July 1st, 2029. 1929. What did it spit out? 400. Pretty sizable number. And then next to that, you see the word high, H-I. It should really be H-I-G-H, but I just abbreviated it. 384. What is that? Well, that was the price of the Dow Jones at that time, soon after July of 1929. You notice how I said after? Because predictive scoring isn't of much help or isn't very useful if it scores something that's already happened. So this price 384 happened after July. Okay. And the low that followed the high was $40 a long time ago, right? What was the decline percentage? 90% decline. Oh yeah, now you know why it's called the Great Depression. Okay, next one down. July of 1987. And it doesn't escape my recognition that both of those happened in July. But I won't go there for now. Score, 389. Not one of the highest scores, but still significant. The high that soon followed was $2,746, or points. I like to say points. And the low was 1616. 41% decline back in 1987. For those that were around back then, I was not too long out of high school. That's right, revealing my age, I'm in my mid-50s. 41% decline, I remember that very well. Next one, May 2007, a score of 394. You can see the high and the low there, 54% decline. Oh boy, was that a biggie. 54%, massive. Next one down, May 2011, to score 450. That's a big score. We had a decline of 19%. I'm not going to dive too deep, but I want to make a comment here. It's clear to me that we begin to see in this era manipulation, monetary policy manipulation is going on. That's a story for a different day. Next one down, November 2014, a score of 444. That was a big number. Sure enough, a decline happened soon after, 16%. December 2017, score of 420. Some of you now remember some of these dates. Am I right? I remember December of 2017. I remember even speaking with Steve Miller about that. We chatted a little bit about that. I think we shared an email about that. Look at that thing. That score, 420, 12% decline. November 2019, score of 391, a decline of 38%. Okay, that was going into the pandemic. So there's some global, stuff going on there to influence that decline that made it larger than what we normally would see. Well, I shouldn't say larger than normal, not necessarily true, but it definitely enhanced the decline. Now, here we are, the green line at the bottom, July of 2021. Look at the score, guys and gals, 427. Wow. 427. We can just look historically. I just picked out some of the big ones. There are definitely some other months in there throughout the history of the Dow Jones that we could have picked out that would probably show the same thing. At least most of the time it would. Not always, but most of the time. 427, big number. Guess what I'm doing? I'm taking the lowest percentage decline of all the ones I've looked at, 12%. The one back in 2017. If we just go with the lowest one, it's 12%. So I think the Dow Jones could pull back from 35,000 all the way to 30,000. I'm not saying it will. I'm saying it could. And at the end of this video, I'm going to tell you why it doesn't really matter. It doesn't really matter the decline. You got to get away from trying to know exactly how much the decline is. That is bad trading strategy. You need to get that out of your mind. You just need to know that the decline is going to happen, or you believe it's going to happen, and then get confirmation that it does happen and trade accordingly. I'm going to show you that here in a little bit. Okay, so that's what I got going on. Just kind of a guide. I got a big score there. I've got cycle analysis. Let me go back to the cycle analysis chart. Bring that up. And so we got a predictive forecasting and cycle analysis both saying something's going to happen pretty soon. Okay? And we looked at skew briefly. I didn't dive too deep into that because I need you to do your own due diligence. Do the homework. Okay, let's finish this video up. I know it's long. I'm glad you stuck around. But now let's finish up this video and let's look at how am I going to trade it. How am I going to trade this? So here you go in front of you, the E-micro Dow Jones futures. Okay, yes, I'm going to trade the Dow Jones. Why wouldn't I? I just looked at took the time to look at the data. And I got a high degree of confidence that there's going to be a pullback. The one that just happened there last week or the week before, wherever it was, a few days ago, I traded the E-micro S&P 500s when I did that. I made about $500. I had, I think, four or five contracts. I made $500. How did I do that? How did I make $500? Let's talk about it. I'm going to use the same exact order strategy or order, the way I'm going to place my orders or order or take a position. Okay? So now I have a high degree of confidence that I believe the week of August 16th, thereabouts, a little before, a little after is okay, that we're going to begin to see a pullback. We're going to see some things happening. Okay? So how am I going to know when to enter? Because I'm going to look for confirmation. I'm going to look for momentum to begin to tip over. Okay, remember the Big Daddy forecast I talked about, it's predictive. It'll already be pointing down. The Big Daddy forecaster, which is predictive in nature, it's already going to be pointing down saying this is soon going to go down. That's helpful, right? So momentum's going to be peaking or just beginning to roll over, but the forecaster is already going to be pointing down. Everybody follow me on this? You get it? Forecaster will already be going down, but the momentum will be peaking and rolling over. Now, I don't want to jump in when momentum's sitting at its peak. That's a big no-no. I'm going to wait till it begins to roll over a little bit, have what we call a crossover. There's going to be a crossover. And when it crosses over, am I going to jump in? Am I going to get in there and I'm going to my account? I'm going to get in there and I'm going to leverage up and use and get my 10 contracts, whatever. Nah, heck no. I'm going to take one or two contracts, probably one. I'm going to short one contract. I'll repeat. What am I saying? You want to take a small position, a little nibble. As a matter of fact, for traders that have been hurt and frustrated and you've been broken a little bit emotionally, financially, then I got something that's going to help you out a lot. You should almost always, in fact, for the near future until you get good at trading and understand how to manage your risk, you should always take a very small position when you enter. Small. If you're trading stock, I don't care if that's 1 share, 5 share, 10 shares, whatever. Whatever constitutes small in relation to your account. For me, I'll take 1 contract, maybe 2 at the most, even on the E-micros, which, by the way, the Dow Jones E-micro has one of the lowest initial margin requirements. Very attractive. Makes it really easy for me to trade. Okay? So I encourage you, if you're, and again, I don't give financial advice, guys and gals, so let me put that in there. I'm just showing what I do. Make your own decisions. But what I'm going to do is, at some point, when I see that the Big Daddy forecaster is beginning to go down and momentum is beginning to cross over, I'm going to take a small position, probably 1 contract. I'm going to wait for confirmation to see if momentum continues to go down and pricing reflects that it's going down as well, right? I want to see everything lining up. And then I might add another contract, especially if momentum starts to gain in the downward direction. In other words, I got red candlesticks on the damn screen. I got red candlesticks. And the next day's candlestick is below the previous day's candlestick, or only a little piece of that candlestick is intruding into the previous day's candlestick. Those are all really good signs that the market's going down. Okay, you need to, if you don't know about candlesticks, well, take the time to study it. So that's what I would do. I'm going to take a small position. I'm going to nibble when I think it's approaching. I'm going to begin to be paying close attention around the week of August 16th, maybe even the week before. I'd be paying close attention. That's called managing risk, guys and gals. What does it mean when you hear the pros, the veterans talk about managing risk? I'll give it to you simple, straight. Take a small position. That is a great way to manage your risk. Just take a small position and wait for the market to move in the direction you want to move in. Because guess what happens if it moves against you? You've got a small position. It won't crush you. You can wait out the market a little bit. You can wait to see if it's going to turn. Because you have all kinds of cushion room for the market to work against you. I wouldn't say hang on to it forever if it starts working against you really bad, okay? So the last thing I'm going to say here about managing risk is after you take your very small position, you want to put in a trailing stop or some kind of protective order. When the position you're holding starts to turn profitable, you most definitely want a trailing stop or some other type of order strategy that's going to protect your profits. You can't just leave your positions hanging out there willy-nilly. Okay? Now, how tight do you want your trailing stop? I'll leave that up to you. Okay? This is just a reference. I'm not saying you should do this. This is what I did when I made my $500 on my 5 little contracts on the E-micro S&P 500 just a couple weeks ago. I put a $10 trailing stop on it. I waited a little bit. As soon as I had to wait like a few days because I got in just a little too early. But I only had like 2 contracts. Okay? You begin to hear me now? I had 2 contracts. I could wait it out. It went a little bit higher, went a little bit higher. I got as much as maybe $700 or $800 down. Okay, and my cut it loose was going to be $1,000. Okay, I waited it out. Eventually, the market started to turn in my favor. And it started coming down, because why? Because I had used my predictive analysis. I knew the market was going to pull back. I got a little anxious. I got a little bit early, but it's okay. It happens. The market started working in my favor, kept working in my favor. It went profitable. I had to cancel my stop loss order, and I put in a trailing stop. Did you hear what I just said? The two key things you want to take away about how you're going to place an order. I'm not going to say that. How I place an order, how I do it. I had a stop loss in there to guard against big losses. And when it turned profitable, I canceled my stop loss and I put in a trailing stop. Why? Stop loss protects you against big losses. Trailing stop locks in your profits. I'll repeat, stop loss prevents you from big losses. Trailing stop locks in your profits. How much you want to trail, that's up to you. All right. I hope you got something out of this video, guys and gals. I know it's been a long video. I'm glad you stuck around. Don't forget to subscribe. Click the notification bell. Give me a thumbs up. Very few people talk about predictive analysis because most people don't know about it. It's reserved usually for big funds, but you just heard it here. Okay? The chances, the probability of a pullback somewhere around the middle of August is high. How much? I don't care. I don't care how much it pulls back. My order strategy will make me profitable if it does go profitable. I don't concern myself about how much the pullback is going to be. As soon as I get profitable, I lock it in with a trailing stop. And I just sit back and let it make the money. If I stop out, oh well. If the market moves, if I missed $10,000 of the profit and only made like $750, yeah, I might not like it, but oh well. Nothing precludes me from jumping back in, by the way, if I wanted to. But the point is, trailing stop is going to lock in my profits. I'm a happy camper. I don't care how much it pulls back. I allow my order strategy to manage that. Okay? All right. Hope you enjoyed the video. Talk to you all real soon again next time.